Welcome back to this continuing series of lectures on the principles of macroeconomics. So far, we've made it through the first third of the course, and we're entering the second third. So we are now on topic 16 and about to examine gross domestic product, sources of data, definitions, how it's measured, and other things of interest related to gross domestic product. So to begin with, I would like to reintroduce the circular flow of economic activity, which I had introduced back in, I think it was topic 8 or 9. There's a simple flow I'm trying to find. Let me go and find the lecture series. Here it is. Yeah, these are the topics from the first exam that we've already covered. So it was in the process of going through discussing production possibilities, frontier, and then a discussion of how a society might choose where to produce on the production possibilities frontier and how to produce the goods that we discussed. There were 3 questions that every society had to answer, no matter what, whether they were hunting and gathering, agricultural, um, or more advanced economic societies like we have today. And the questions were what to produce, how to produce it, which are the 2 connected to the production possibilities frontier. And then the third one, to whom to distribute the output. We said there were 3 archetypes that answered these 3 questions, and those were traditional society, where tradition answered the questions. Then there was a command society, or planned society, or what I labeled socialist society, where everything was rationally planned by government bureaucrats. And then there was pure capitalism, where a free market a system based upon private property answered the questions. And so socialism, of course, answered it by planning, planning, planning. Everything was in the plan. Capitalism, it was harder to say how they answered it, but basically it was through a price system. And that's where we came to the simple circular flow of economic activity. And here is that sketch, that model of the market system with households here and business firms here. They interact through these markets, the factor market, money market, and final goods and services market. And the prices, interest rates, wages and salaries, and interest and rent determine how resources are allocated and which ones get produced. So what to produce is decided in this market, and who gets what is produced is decided in this market based upon what people earn based upon their wages and salaries, rent, interest, and profit, which is their income. And it's with income that you can buy the goods produced here. Well, we're going to take a look at a more complicated version of that model that we'll use in macroeconomics. So we'll want to draw the circular flow of economic activity, labeling all economic actors. So we have the households and business firms already. Markets, the same 3 are there, though in macro we pay much more attention to the money market and the money flows. And then part B is hard to do without doing topic number 17, And you can see that the topic 17, we're going to define GDP and discuss why money prices are used, what items are not included, but finally we get to D and E and talk about the expenditure approach and the income approach. And those are what I'm referring to here. So I'm never quite certain whether to put a topic 17 first and then follow with the circular flow or vice versa. But the circular flow is useful in helping define GDP by the expenditure and the income approach. And later on, we're going to, and I think I'll scroll down to some later topics. We're going to take a look, for example, once we start building our theoretical model at aggregate demand, aggregate supply, and that will be right here in this final goods and services market once we get there. And then even further down, we'll talk about the Keynesian demand management stuff, and it looks like that we're not going to get into fiscal policy until the third part of the course. That'll probably be topic 34. And then monetary policy is also aimed at manipulating the total demand in the final goods and services market. But the circular flow is going to help us, sort of picture that in our minds and understand what's going on. So let's get to it. The macro circular flow, and here it is. And I just wanted to point out that, let's see. Yeah, I think blue is okay. That we still have our two primary actors, business firms and households. So business firms produce, in general. They also consume the factors of production. And households consume, and I know I have consumption right here, but they also reproduce themselves. But basically, in our model, we just need to focus on production and consumption here, okay? Then we've introduced a couple new actors, and the third one is government. And really, the federal government is the one we're mainly going to be concerned with. And I use federal because we are in the United States, but it would be a national government if we were elsewhere. But we don't want to ignore state and local governments either. So all levels of government, all the way up from ACC, which is a governmental entity, to the city of Austin, Travis County, the state of Texas, on up to the United States government is included here, okay? And then our fourth actor are foreign economies, just lumped all together in this box, okay? So we've added a couple actors, and it looks like we have a very complicated sort of electrical wiring system mapped out here, but these all are mapping, for the most part, flows of money. So obviously, this is a flow of money, income, and you see the dollar sign here. And so when business firms buy factors of production, they're sending money up to households as income. The households then will have to pay income taxes on that, and some other taxes too, like property taxes at the local level. Now, sales taxes are down here. So sales and excise taxes are down here. Excise taxes are like the tax you pay on gasoline. They're a per unit tax, but business firms collect those taxes and send them to the government. Income taxes, property taxes come in here, and sort of hidden, and we'll talk about this later, are we don't have any corporate profit taxes coming out of businesses. We assume since households own those corporations through stocks, that they're the ones paying that tax, okay? And so that is a money flow into the government. And the government will then, and this is the biggest part of the federal government budget, will send money back to households in the form of Social Security payments, supplemental security income, and also transfers in kind like Medicare, Medicaid, and food stamps and housing subsidies, all sorts of things transfer back to households from the government. But the government takes the rest of the money and spends it on its employees, the people who staff and run the governments, police, courts, bureaucrats, and teachers like me. So, of course, they pay for tanks, bullets, and other things for the military. And they also pay for building roads and keeping up the public infrastructure of the country. So those are all purchases of goods and services and come into this flow. When we come back to the households, once they've paid their taxes and decided what money they're going to save, which will go down here to the money market, they will then spend the rest on consumption goods, and that money will flow down here. So what we have here is household consumption. I can't draw off there. So we're going to define GDP soon enough. So I'm just going to put this here as household consumption plus government spending for goods and services are the two flows. So here's one. Here's the second one we've talked about. All right, and we'll start building that up soon. And as households send their money to buy goods and services, some of it gets siphoned off because many of the goods we buy come from foreign countries, like my cell phone, my shoes, many of my clothes, etc., come from abroad. So notice that the money goes out, but the goods come in, and I don't have a flow showing the goods coming in. Foreign countries buy a lot of the stuff made in the United States, from tractors to bulldozers to industrial equipment, and most importantly, agricultural goods and raw materials. The United States is one of the biggest suppliers of raw materials to the world. And so that money comes in to pay for our exports. So I'm just going to represent exports by X and imports by M. All right. And that comes into the economy. And I want to add this up here. And there's something I need to add in here we'll get to. So we're going to add exports as money coming in, but then we have to subtract all the money flowing out to foreign economies, and that will be our net exports, all right? And all that money flows right in here, but there is one thing that we have not talked about. And that is that business firms, and we're going to make a simplifying assumption, borrow money mainly to invest in capital equipment, buildings, transportation equipment. And this investment flow is right here. We're going to label that as an uppercase I. And so purchases of business investment are here. And we're going to say that this is the expenditure approach to GDP. Now, once the money is spent buying all these goods and services, the money flows down to business firms as revenue. The business firms take some of that money because they're collecting it for government and send it back up to government. They then set some aside for retained earnings, so some of their profits they set aside for future use. And then this capital consumption allowance is depreciation. They have to set aside money to replace worn out capital. So that goes to the money market. So notice there are three flows of money here. We could say four. One is the savings from households. Two is the retained earnings from corporations. And three is their depreciation sinking fund to replace capital. I could put a fourth in. If governments ran a surplus, they would put it here, but most governments run deficits, so that's a topic for later in the course. But so household business firms borrow money to produce investment goods. And you might say, well, don't households do that too when they buy homes? And some households do if they build their own home. But for the most part, economists believe that business firms, developers invest the money to build the homes, and then they will then sell the homes to households. But anyway, so the money comes in and out. So some of it is siphoned off because there's sales and excise taxes. Then the business firms, of course, the rest of the money, it's really connected to value added. And it goes to labor in the form of wages and salaries, land in the form of rent, capital in the form of interest, and what's left over are profits. And all of that flows, and profits would be dividends, flows back up to the household. Wow, we've completed our circular flow. Notice that there's an income approach here too, if I can do it, squeeze it in here somewhere. Let's see, maybe on the top of the next page. So income approach to calculating GDP is all of this income that's being earned here. But notice that we have to, and I'm not going to itemize it at this point, but basically when I put income here, that's gross income, wages and salaries, rent, interest, and profits. Oh, and I should say proprietor's income. We're not quite to GDP because the total expenditures here are the total money coming in. So we do need to add, and again, economists, this is kind of another thing, assume that the households get all the profits a corporation earns. So really, these retained earnings are theoretically coming from this way, but we do need to add in depreciation and we need to add in indirect business taxes. And if we do all of that, we get GDP. All right, equals the total income earned, gross income, including corporate retained earnings. We do need to put in depreciation. Since that's a cost of doing business, we have to add that in indirect business taxes. There's the income and expenditure approaches to GDP. Now for building dams, if we built so a dam measures a flow just like water through Mansfield Dam. We can measure it in cubic feet per second if we're measuring the flow through a dam or the flow of a river. And GDP is a flow, not a stock. So if I could write that somewhere, I don't know. So GDP, we need to know the difference between flow versus stock. And I think one of the easiest ways is to look at savings up here. So the amount households save every pay period, every week or 2 weeks or month, is a flow. You can measure the flow, how much is being saved per month, let's say. The stock is how much they've accumulated in savings previously. So let's say you're saving $100 a month and you already have $20,000 in your savings account. So the stock is $20,000. The flow is $100 a month. GDP is a flow, not a stock, okay? So we measure the flow of money through here to pay for final goods and services. And that is this little formula up here. The total amount households spend on consumption goods, minus, of course, imports. The total amount government spends on final goods and services, plus their part of imports. For example, they pay for foreign bases for the military. And the total amount business firms pay for capital equipment, minus whatever money they spend abroad for their capital or transportation equipment. And then plus the amount of money foreigners spend on goods produced in the United States. That's the expenditure approach. And if we can measure it, if we could build a dam right here, we could measure it. All right, and you won't find this dam business in the textbook. It's my little addition to the course. The income approach, if we were to build dams, we'd have to build dam 1 to measure the income, dam 2 to measure the depreciation, and dam 3 to measure the indirect business taxes. So this is a little more daunting. And I'm going to let Y represent income. So I'm going to call this Y1. So this is the first dam, and this is the major one, measuring the income going to households. And then, of course, we have capital consumption allowance or depreciation. So if we bid, and we're not going to include retained earnings, but income dam 2 would be here. And then, of course, here is the indirect business taxes. And we'd build dam 3 there. So if we could measure the flow of money past each of these dams, we would get the income approach to GDP. Well, that does it for this introduction to the circular flow of economic activity. See you on the next topic where we get into the high weeds of GDP definition. Until then, have a good time.